Chapter 10 reviews all the ratios that you've learned until this point in the class. It also introduces you to three new ratios. But there's several multiple choice questions on the exam dealing with the ratios, where you're having to compare companies and say which is better or worse, or compare the same company over several years to say if the ratio is getting better or worse. So it's very important for you to be able to interpret the ratios. There will be some questions on the practice exam, and then we're going to do a little bit of that for during the class, during this video lecture, as well as for homework. But most of this should be a review. For ratio analysis, it's very important to have something for comparison. So you would want to compare the company that you're looking at with its competitors, or you would want to use to know the industry averages, so you could compare your company with industry averages, or you could look to prior years within the same company and look for trends within that same company. But most ratios by themselves don't really tell us much unless we can compare it with something else. So I have a review of the ratios in your lecture notes. There's also some tables in your book on page 467 and 468. It highlights all the ratios and it breaks it down by the type of ratio it is, and it gives you the definition of the ratio as well. So current ratio is the very first ratio that we ever learned. It's current assets divided by current liabilities, and it's probably it is the most used asset to judge the liquidity of the firm. The liquidity, that means, is the company going to be able to pay its current obligations when they become due? So current liabilities are due within a year or less. So this measures is the company going to be able to pay those bills as they become due. You want it to be 1 or higher. If you have a ratio of exactly 1, then that means your current assets are exactly equals your current liabilities. So anything over 1 would indicate that you had more current assets than you do current liabilities. A new ratio for this chapter is called cash from operations, and it is also measuring liquidity of the company, but it's looking at just the cash from its operating activities. Net cash from operating activities. That's a number that would come from the cash flow statement. We talked about the cash flow statement early in the semester. The cash flow statement only looks at cash coming in and cash going out, and it breaks down your activities into operating, investing, and financing. So this numerator looks at only the cash from operating activities, and then you use your average current liabilities as the denominator. So this measures is the company going to be able to pay its bills from the cash flow that it has from its operating activities. And that's an important measure because the current ratio uses current assets, but you know current assets includes more things than just cash, right? You could have inventory, accounts receivable, supplies, even prepaid rent and prepaid insurance. Those are all considered current assets. But you can't really pay your bills with some of those assets, right? So that's why this measure is important. Now, let's review current inventory turnover. Is very similar to accounts receivable turnover. Both of those measuring how fast are we turning it over. The number that you get will be turns. So for inventory turnover, if you get a turnover ratio of 5, then that means you're turning over your inventory 5 times during the period. For accounts receivable turnover, it's how many times you're turning over your accounts receivable. So how many times are you collecting your accounts receivable during the year? You can convert both of those into a days, average days outstanding, or average collection period for accounts receivable. And I think the days are easier to understand. You would take 365 days divided by your turnover ratio, and that would give you your number of days it takes on average to sell your inventory, or the number of days on average it takes to collect your accounts receivable. Both of those, for the days, you would want the lower number of days, right? The lower number, the better. If you're looking at the turnover ratio, you would want that number to be higher. You would want more turnover during the period. So if we compare like 5 as the accounts receivable turnover, then that means you're collecting your accounts receivable 5 times a year. Compare that to 10. Well, if you're turning over your accounts receivable 10 times a year, that means you're collecting faster. The higher this turnover is, the better. But the days, if you convert that to the number of days, you would want a lower number of days for both of those. That would indicate better. All right. We're not going to talk about times interest earned. You're not responsible for that one. Debt to equity. Debt to equity, it measures all the debt, which is all your liabilities, compared to your shareholders' equity. This measures how the more debt you have, the riskier the business is. The more debt, the more risky it is. So the higher this number, the more risk that the company has, because it's got to be able to pay its bills when they become due. Also, the higher it is, it's called highly leveraged. So if a company has a lot of debt, you would hear that company be referred to as highly leveraged. It has more risk associated with it. So this debt to equity ratio is looking at the company's ability to pay its long-term debt. And you would want a lower number there. Lower is better there. It indicates less risk. All right. Profitability ratios. How profitable are we doing? How's the company performing? The higher, the better for these numbers. Return on assets. How well is the company using its assets to generate net income? Higher, the better. Asset turnover ratio. That's another way of looking at how we're using our assets. But instead of looking at how we're using our assets to generate income, it's saying it's measuring how we're using our assets to generate sales. Return on equity. This will tell you the income the company is making for every dollar of common stock. How much income the company has for every dollar of common stock. Profit margin ratio, one of my favorites. Profit margin ratio and gross profit ratio are my favorites, I think. Profit margin ratio is measuring how much of your sales dollars are hitting the bottom line. Think about your income statement. The top line is sales, the bottom line is net income. So this ratio is measuring how much of that top line, how much of our sales is making its way down to the bottom line, net income. We want this to be high. Right? The higher it is, that means more of our sales dollars are making it to net income. Gross profit. This measures how much of our sales dollars do we have left after we pay the cost of our goods sold. So what percentage of our sales dollars do we have left to cover all of our other expenses and to make a profit after we pay for our cost of goods sold? Because that's what gross profit is, right? Gross profit is sales minus cost of goods sold. So it's the amount of money you have left after you pay your cost of goods sold. So this is measuring the percentage of sales dollars that you have to cover all of your other expenses. And not just to cover your expenses, you want something left for the bottom line too. You want a net income. earnings per share. That was in the last chapter, in the equity chapter. And it's looking at exactly what the name says. How much earning, how much income do we have per share? But it's per share of common stock. So how much net income is this company generating for every common stock share we have? And two new ratios for this chapter. They're called market indicators. Market indicators. And they're using the current market price, the current price of a share of stock, to either indicate growth potential. This price earnings ratio is a measure that some investors use to see how much potential growth that business has, the growth potential for that business. So the higher, the better. The higher, the better for that. Dividend yield ratio, it looks at the dividend per share divided by the current market price of each share. And this tells you, this would indicate what is the investor getting back from the company in dividends. What is the percentage of return that the investor is getting in dividends? We talked about this, I think, in the last lecture, but some investors want dividends, right? They want the companies to pay out the earnings back to the investors, back to the shareholders as dividends, because those investors want the cash flow from that. Some investors don't necessarily need the dividends. They would rather the company reinvest that money back into the company. So they would rather take the earnings of the company and instead of paying dividends, reinvest that. So buy more equipment, buy more factories, buy more franchises, and build the company up to make more net income. So it just really depends on the investor whether they would want a high dividend yield or not. The higher the yield, that means they're paying more dividends. Now, let's look. I want you to print this off if you have not. It's on D2L, and it's called the Nike in-class handout, or something along those lines. Right here, Nike ratio analysis, Nike ratio analysis. I want you to either print that out, or if you can do it, I like to print it out because I like to circle my numbers and stuff when I'm doing computing ratios. But it gives you the Nike balance sheet, and it also gives you Nike's income statement. And then it asks you to prepare the ratios. Remember that you're going to have the ratio handout, and it's on D2L. You've had it on the prior two exams. It's going to be exactly the same handout on this exam. So you'll have all the formulas for these ratios. But I want you to take the time now, pause the video, and work these ratios for yourself. And then we're going to compare the ratios that you computed with Adidas, a competitor, and say whether Nike is better or Adidas is better. But if you're not actually doing the ratios, you can mess up on the exam. So I want you to practice actually doing the ratios yourself. So pause the video, get that ratio sheet off of D2L, print this handout, this Nike handout out, and then come back to the video. I have all the ratios here for Nike. These are the ratios in this first column that you should have computed using Nike's balance sheet and Nike's income statement for 2011. We're going to compare those, the Adidas numbers, some numbers I just made up. We're going to compare and say whether Nike's better or Adidas is better in each of these ratios. All right, current ratio measures liquidity. Both of them are fine. There's no problems with either one of these ratios. We want the current ratio to be over 1, and they both are. So both of these companies have more current assets than they have current liabilities, and they should not have problems paying their bills as they become due. So both of them pass that ratio. The next is accounts receivable turnover. And this is turns, not days. So Nike is turning over their accounts receivable 5.5 times a year. Adidas is turning over their accounts receivable 7.8 times a year. So which one is better? Adidas. Adidas is collecting their accounts receivable faster than Nike. If it's hard for you to see this, to understand the turns, you can convert those to the days by taking 365 days, divide it by this ratio, and you'll get the number of days on average it takes for the company to collect its accounts receivable. So here we said Adidas was better, but when we convert it to days, let's look. And it's very easy to see Adidas is better there after we convert the ratio to days. Because Adidas is only taken about 47 days to collect on its accounts receivable. Nike is taking 67 days. The shorter time period to collect on your accounts receivable, the better. Companies don't want accounts receivable on their books. They want cash. So they want to turn those accounts receivable into cash as soon as possible. Inventory turnover ratio, which is better? Nike is turning over their inventory 4 times a year. Adidas almost 3 times a year. So Nike is better. Nike's selling its inventory faster. We don't want inventory to sit on our shelves for a long time. We want to sell that inventory fast. So Nike is selling faster. That's better. You can convert that to days, and it may be easier for you to see days. Nike on average is keeping their inventory on their shelves for 83.5 days before it's sold. Adidas has its inventory for 129 days before it's selling it on average. So you can see with the days, you can see Nike's better at selling their inventory faster. Debt to equity. Nike has less debt compared to equity, so Nike is better there. Less risk there. Return on assets. Return on assets, all of our profitability ratios, the higher the better. So your return on assets, your return on equity, the higher the better. So here, return on assets 7, Nike is better there. Return on equity, this is looking at our return for every dollar of common shareholder stock that we have. Adidas is better there. Asset turnover. How well are we using our assets to generate sales? That's what asset turnover is. They're both pretty good and both really kind of close, but Nike is a little better. Profit margin and gross profit ratio. My 2 favorite ratios here. Profit margin. Let's look at this. Profit margin. That measures how much of every sales dollar is hitting the bottom line. How much of every dollar in sales does the company have hitting net income? Becoming net income. The higher, the better. You want more sales dollars to make its way to net income. So Adidas is doing better there. Adidas is being more profitable. Gross profit. How much of our sales dollars do we have left to cover all of our other expenses after we pay for cost of goods sold? That is what gross profit ratio tells us. And Adidas is doing better there. Higher.